This infographic maps a 22-point gap between the soft landing narrative and the reality capital markets are pricing. Markets assign a 62% probability that inflation holds above 3.9%, while the public implies only a 40% chance. That abstract data translates to a physical cost. The national average retail price for gasoline sits at $4.55 a gallon. You feel the friction every time you swipe your card at the pump. You are absorbing the financial hit in real time, even as you wait for a news headline to validate that the economy is safe. This creates an internal conflict. Your personal balance sheet is telling you one story, while the public narrative is insisting on another. Trusting the soothing language of a broadcast over the mathematical data of the market leads to a practical misalignment. It leaves you reacting to a version of the economy that the capital markets have already discarded. The primary underlying mechanical driver of this persistent inflation is actually a massive supply-side energy shock originating overseas. Crude oil is up 40% since February of 2026, and the Strait of Hormuz remains heavily constrained, despite political frameworks attempting a ceasefire. This sustained energy shock has triggered a historic collapse in consumer sentiment. The sentiment index dropped to 48.2 in May, a reading lower than the 2008 financial crisis or 2020 lockdowns. This creates systemic paralysis for the Federal Reserve. Monetary policy cannot print barrels of oil, and interest rate hikes cannot bypass geopolitical bottlenecks in the global supply chain. Stressing over these rising prices means attempting to mentally solve a supply-side math problem that the central bank itself lacks the tools to counteract. The global economic machinery is running a cold optimization function. Within that equation, a rising cost of living for the individual is mathematically unavoidable collateral damage. This infographic shows the tool capital uses to read reality faster than the public, the Cleveland Fed's daily nowcast model. By ingesting daily crude prices and weekly gasoline costs, the model currently projects the May Consumer Price Index at a persistent 3.89% year-over-year. The market uses this model to price risk continuously. The public waits for lagging, backward-looking official press releases published once a month. Relying on those monthly public briefings provides a psychological shield against the stress of high prices. Capital, meanwhile, uses the daily data as a strategic weapon. These two timelines are moving towards June 10, 2026. June 10th marks the inevitable moment the lagging public narrative collides with a market reality priced weeks in advance. The day after that June 10th data prints, the media cycle will finally abandon the story of easing inflation and acknowledge the persistence of the price shock. Narrative-reliant households will likely feel the weight of that news as a fresh shock. The capital class will be executing on a reality they confirmed 32 days prior. The rules of this system are absolute. You cannot reopen the Strait of Hormuz, alter the central bank's mandate, or change the impending data print. You can, however, choose to stop waiting for the hollow reassurance of the soft landing narrative. Accept the stark realism of the 3.89% data. The exactness of that number provides the friction necessary to finally detach from the noise. Standing firmly in the truth of the data allows for a total release of the anxiety associated with trying to control